The trial balance statement grade 11 accounting. The debit and credit concept is used to record business transactions to the ledger accounts. Using this double entry system ensures that all transactions once posted are correct by ensuring that all debit transactions equal all credit transactions. In this lesson we look at some special types of accounts and at the trial balance statement. Exceptional balance accounts occur when the final account balance is calculated. It has the opposite debit or credit balance from what that type of account should normally have. Thus, for instance, if the cash account, which normally has a debit balance, has a credit balance as a result of transactions, it is considered an exceptional balance. Some examples and reasons for exceptional balances are: a customer overpays their accounts receivable. She owes us $100 and pays us $150. Posting these transactions would result in a $50 credit side final balance. This would be an exceptional account. The on-account concept. Buying and selling on credit. Most companies, to stay competitive, sell to customers on account, or sell on credit. And companies also buy on account, or buy on credit. This means that goods sold would be paid for later, and accounts receivable instead of immediate cash. Business will normally give a customer 30 days from the receipt of goods to pay for the amount invoiced. This is the on-account concept. There are 4 very important transactions done on account as a business. If you purchase goods from a supplier, the transaction is called a purchase on account. Ordinarily this would be a debit to an asset account and a credit to accounts payable. When a business sells goods to a customer to be paid later, this is known as a sale on account. The accounting entry for this would be debit accounts receivable and credit owner's equity. Paid on account means you paid using cash the accounts payable owed. Debit accounts payable and credit cash is the accounting entry here. Received on account means the customer pays cash for the amount she owes you. You would debit cash and credit accounts receivable.
The trial balance. A trial balance statement is used to show that all debit account balances equal all credit account balances in the ledger. A correct trial balance shows that all accounts have been balanced correctly. To create the trial balance, you transfer the final account balances you calculated in your T accounts to the debit or credit columns of the trial balance statement. You then add all the debit column amounts to come up with a debit total, and all the credit column amounts to come up with the credit total. If the debit total equals the credit total, the trial balance is in balance. If not, then an accounting error has been made. Account balances are listed in the correct debit or credit column. Also notice that no dollar signs are required. Accounts are listed by assets first, then liabilities, and then equity accounts. This is the same order as accounts are usually listed in the ledger. Notice that the 2 columns are equal, or in accounting terminology, the 2 columns agree. You do not have a correct trial balance if your 2 columns do not agree.
This is the end of the trial balance section. They told me this tattoo was temporary.